Institutional capital managers look at decentralized finance and see a math problem they desperately want to solve: automated yield, instant settlement, and continuous liquidity. But they also see a legal reality they cannot ignore. Regulated banking capital cannot legally mix with anonymous, potentially sanctioned wallets in open liquidity pools. The crypto industry's standard response has been to build the open network first and figure out the rules later. On networks like Ethereum and Solana, developers try to solve this institutional problem by bolting compliance controls onto the application layer, long after the base protocol is already running. This means building bespoke smart contracts on top of the open base layer. The application acts as a bouncer, creating inherent structural fragility. Every deployment needs a novel audit, and institutions end up hoping the smart contract logic holds up under pressure. The XRP Ledger is taking the opposite approach. Instead of building an open venue and trying to install security cameras later, XRPL is embedding regulatory controls directly into the base protocol layer, long before courting the liquidity. Over the last 18 months, developers and node operators have quietly passed a series of amendments that write identity verification and access controls straight into the network's core consensus rules. Compare that to Ethereum. If a bank wants a compliant trading pool on Ethereum, they have to build a custom application to host it. On XRPL, the compliance tooling isn't an application running on the venue. The compliance tooling is the venue. That design choice carries a heavy cost. By restricting open access, the network sacrifices retail meme coin volume and frictionless developer onboarding in exchange for absolute protocol-level regulatory clarity. XRPL is systematically rebuilding the traditional banking back office out of cryptographic primitives. Any legally compliant financial system has to begin with identity, but blockchains inherently struggle with a core tension. They broadcast every transaction transparently, while financial institutions require strict privacy. To solve this, the ledger relies on its first primitive, on-chain credentials linked to decentralized identifiers. Trusted third parties issue digital credentials directly on the ledger, while sensitive documents remain strictly off-chain. These credentials feed into permissioned domains, a gated perimeter requiring every participant to hold a badge. Without it, the network physically rejects your transaction. Anyone outside the domain simply cannot trade with anyone inside it. That removes the risk of an institution accidentally interacting with a sanctioned entity or an illicit mixer. This architecture directly enables the permissioned DEX. It extends the ledger's native order book exchange right into these controlled, isolated environments. Regulated firms can now run tokenized asset markets with total anti-money laundering enforcement while still settling trades instantly on a public blockchain. By making identity and access native ledger objects rather than a set of smart contract rules, XRPL eliminates the possibility of application-level misconfiguration. A compliant boundary is useless if you don't have capital markets infrastructure to operate inside it. That infrastructure arrives with the pending activation of the ledger's native lending protocol, powered by the Single Asset Vaults Amendment, known as XLS 65. Open DeFi lending protocols rely entirely on over-collateralization and instant algorithmic liquidations. If your collateral drops in value, code automatically sells your assets. This protocol takes a different route, supporting uncollateralized fixed-rate loans. Borrower evaluation and credit scoring stay completely off-chain within mature institutional models. Once approved, the on-chain protocol automatically executes the issuance and records the rigid repayment terms on the ledger. The economic engine driving this specific credit market is Ripple's RLUSD stablecoin, operating securely under a New York trust charter. Institutional borrowers will take fixed-term dollar credit funded directly by RLUSD pools, operating securely inside these permissioned vaults. Treasury firms like Evernorth are already preparing to deploy capital into this exact yield structure, recognizing the multi-billion-dollar potential of an efficient, compliant lending market. This credit engine bridges the gap between traditional finance risk modeling and blockchain settlement speed. It effectively denominates a short-term credit curve in a regulated digital dollar. Even with identity verified and credit flowing, there is one final requirement. In professional money management, full real-time transparency is a bug, not a feature. No institutional trading desk can afford to have its inventory and positioning entirely legible to competitors on a public block explorer. Developers are applying zero-knowledge proofs to multi-purpose tokens. A cryptographic shield encrypts transaction amounts, turning legible data into unreadable code. This allows institutions to move assets privately, while specific decryption keys can be handed to auditors on demand. Look at the sequence built so far: identity through credentials, access control through domains, secure asset management, native credit markets, and finally, confidentiality. Privacy with strict accountability is the final primitive required to make a public blockchain viable for Wall Street-scale operations. Upgrading a blockchain with this much institutional infrastructure creates significant operational friction. XRPL's governance architecture moves at a glacial pace compared to modern developer networks. Protocol upgrades require a continuous 80. This creates a highly conservative, frustratingly slow upgrade path. While this deliberate slowness is heavily criticized by crypto natives used to moving fast and breaking things, it functions as a foundational security guarantee in a bank's vendor risk review. But maintaining this minimalist, highly secure mainnet introduces a severe complication. Complex programmability has to be forced off-chain. To accommodate builders, the ecosystem uses a dual-track system. Teams that need full composability and general-purpose smart contracts must build on the bridged EVM sidechain. This fragments liquidity and splits users across two distinct environments. And because those environments are connected by a bridge, it relies on what has historically been the industry's most reliably exploited vulnerability. Ultimately, XRPL is betting that large-scale institutional flows will prioritize the slow, hyper-secure mainnet over the fast, flexible sidechain. This architecture is already moving from theory to production. Over $3 billion in tokenized real-world assets currently sit on the XRP Ledger, and this growth mechanically links back to the native token. Through a process called auto-bridging, as institutional stablecoin corridors grow, the network automatically routes trades through XRP whenever it optimizes pricing. The outstanding risk is no longer technical, it is behavioral. The network has built a pristine, perfectly documented institutional credit market. Now, the capital must willingly make the jump. Most blockchains launched permissionless environments to attract speculation and are now spending years trying to retrofit the controls that institutions require. XRPL ran the sequence backward. They accepted years of looking quiet next to meme coin networks in order to meticulously construct a digital vault. As global regulatory clarity crystallizes, the chains that ultimately capture institutional flow will be the ones where compliance officers don't have to compromise. That is the exact bet XRPL has staked its entire architecture on.